After studying this module, you shall be able to understand about the IMF institution and its funding facilities. Know about World Bank and its basic features. Know about the constituents of the World Bank. Differentiate between IMF and World Bank. Know the concept of optimum currency area and its applicability. Know about the historical experience of Indian exchange rate system. To begin with, for an effective and smooth global business, for having the legitimacy in the collective action, and for having the horizontal accountability amongst various countries, there was a dire need of creating international institutions which can facilitate international business governance. It was the 20th century when initial one half of the century witnessed two world wars and a Great Depression, and another half of the century witnessed prosperity, in which then international organizations such as WTO, predecessor of GATT, started. WTO gave a platform to various countries to negotiate the trade agreements, and another international organization. International Monetary Fund, or IMF, was formally established on December 27, 1945, when 20 countries signed the Articles of Agreement, but the conception of the idea of forming such international organization was laid in the Conference of 44 countries, named the United Nations Monetary and Financial Conference in July 1944. The IMF is an inter-country organization which follows the macroeconomic policies of its member countries and keeps a track of impact of these policies on countries' exchange and balance of payments, and thereby keeps an eye on global financial system. IMF as an institution has objectives to stabilize exchange rates and aimed at liberalizing the economic policies of the member countries to facilitate loans and aids for other member countries. International Monetary Fund at times gives the loans to its country members at different conditions who are in dire need of financial aid. Objectives of International Monetary Fund are as under: to promote monetary cooperation throughout the globe, to increase the international trade, to attain financial stability, to implement the philosophy of sustainable development, to increase employment avenues, to reduce poverty. Membership in IMF. Membership of International Monetary Fund is based on quota system. Quota is based on the relative size of the country in the global economy. Quota of the member country defines its subscription limit, its voting rights, and country's share in the special drawing rights, or SDRs. Funding facilities of International Monetary Fund. International Monetary Fund was established with the objective to provide financial aid and assistance to the countries who were the victims of the Great Depression of the 1930s. For this purpose, IMF utilizes the funds deposited by its member countries. Of late, IMF is fulfilling the same objective by giving the financial assistance to those countries which are experiencing the balance of payment crisis. In return, the lending countries get benefited from the modification and reforms made in the fiscal, monetary, and the political policies of the borrowing nation. Structured adjustment programs are also conducted by IMF to ensure least occurrence of financial crisis by that country in future. Of late, the economic crises have been faced by the major portion of the world, especially the European countries. The IMF made a comprehensive plan for the financial integration. The Executive Board approved 5 arrangements under the non-concessional financing facilities of IMF. Among those, 1 each was subscribed to Mexico and Poland, and 3 arrangements are subscribed to 3 countries of Europe.
A trust named Poverty and Growth Trust has been formed under IMF, which supports low-income member countries, that is PGRT. With the help of the assistance provided by this fund, concessional financing is being done to the poor member countries for their upliftment. IMF also has the provision of the bilateral borrowing from the member countries. World Bank, International Bank for Reconstruction and Development, known as World Bank, was established in 1944 with the objective to re-establish the war-devastated countries. World Bank not only aimed at reconstructing the economies, but it also emphasized on the long-term funding. World Bank's head offices is located in Washington, D.C., USA. The president of the World Bank is nominated by the President of the United States but is elected through the Board of Directors. World Bank is an international organization which is owned by the governments of various countries, and these governments have their subscribed share capital which are directly linked to their voting power. The basic voting power arose out of the basic share capital, but this voting power can be increased with the increase in the financial contribution to the World Bank. Basic features of the World Bank. World Bank is an international organization. World Bank provided financial assistance to reconstruct the devastated economies. World Bank main objective is to assist the less developed economies to develop. World Bank provides the loans to the economies for developing infrastructure and industries. World Bank, besides giving the loan, also gives a technical assistance to least developed nations. It provides experts from outside and at times provide training to the existing personnel. Issues like dealing with climate change, gender equality, and poverty eradication has become key objectives of the World Bank. World Bank is mainly dominated by Western countries. The bank also serves as one of the implementing agencies for United Nations Global Environment Facility, that is GEF. The World Bank constitutes of its various agencies, which makes it a World Bank group. Each of the agencies have its own articles of agreement, which serves as foundation for their activities. Presently, there are 188 members of the World Bank. The members of the World Bank are all those members who are members of IMF. The World Bank comprises of its 5 agencies, which are deemed as the constituents of the World Bank. The constituents are given the following: International Bank for Reconstruction and Development, that is IBRD, International Finance Corporation, that is IFC, International Development Association, that is IDA, Multilateral Investment Guarantee Agency, that is MIGA, International Center for Settlement of Investment Disputes, that is ICSID. The IBRD and IDA provide loans to least developed countries. Loans are provided to them for making major adjustments and changes in sectors of the economy. For example, funds are provided to take initiatives for dealing with climate change. On the other hand, the working of IFC and MIGA, that is MIGA, includes the investment in the private sector and insurance to the development of the private sector. IBRD aims to reduce the poverty levels of the developing countries, which includes middle income and least developed countries. IDA provides interest-free loan to the least developed countries or LDCs because these countries don't have the power and capacity to repay the loan on current market rates. IFC aims at developing of the economy through the investment in the private sector. It also provides insurance to the private sector. MIGA aims at promoting and increasing the foreign investment in the developing countries by the developed member countries. This agency provides the insurance and the guarantee to the foreign investors against the political disturbances and other externalities. The ICSID's objective is to settle the disputes regarding investment between the member countries. The agency settles the disputes with the technique of arbitration and conciliation. This helps in building an atmosphere of mutual trust and confidence between the host and foreign investors. Difference between IMF and World Bank. IMF and World Bank both were established after the Great Depression in 1930s, which witnessed currency devaluation and restrictions and barriers in trade. IMF was established in 1946, whereas World Bank was established in 1944. World Bank is a sister concern of the IMF, but it has its own distinct objectives as compared to the objectives of IMF. The objectives of the IMF were to promote exchange stability and support the multilateral system of payment, whereas the objective of World Bank is to provide long-term funds to its member countries for an accelerated growth. The World Bank objective is not only to ensure the sound fiscal policies of the member countries, but to ensure the long-term sustainable development. The main difference in IMF and World Bank lies in its objectives and working of both of the international bodies. The IMF looks forward towards sustainable international monetary system, whereas World Bank aims to promote the development in world by the supporting and funding poor member countries. IMF promotes exchange rate stability among its member countries, whereas World Bank provides the long-term funds to bring fundamental changes in the economy. IMF provides financial assistance, which in short term or medium term to member countries to overcome the exchange imbalances, whereas an agency of the World Bank, IDA, provides a special funding to poor countries on long-term basis. International Monetary Fund works through the system of SDRs, that is special drawing rights, which is in the direct proportion of the contribution of member country to IMF, whereas the World Bank voting depends upon the subscription of the members to the basic share capital. IMF gets the funds basically from the contribution by its member countries, whereas the World Bank requires most of the resources from the international bond market. International Monetary Fund comprises of 4 credit lines such as flexible credit line, precautionary credit line, standby arrangement and extended fund facility, whereas World Bank has mainly 5 agencies such as IBRD, IDA, ICSID, MIGA and IFC. To summarize, it would be apt to conclude that IMF is about stability and World Bank is regarding growth. The concept of optimum currency area and its applicability. The concept of the optimum currency area was propelled by Mandal in 1961. The optimum currency area is a geographical area that follows the fixed exchange rate system or it adopts single currency within that geographical area. It depicts the optimal collaboration of various currencies to establish the new currency. Optimal currency area validates when the area whose currencies are merged is more than a country. For example, creation of a currency called euro holds the concept of optimal currency area for an entire Europe. Some economists, however, argue that an optimum currency area could be smaller than a country, such as United States, where some regions of the United States do not sync with optimum currency area as compared to the rest of the parts of the country. Mandal gave 2 models to explain the applicability of the optimum currency area. The first one is labor market. Optimum currency area allows the labor mobility across the area. It has an automatic adjustment mechanism in relation to the issues like visa, pension, transfer, etc. The second one is capital mobility. The price and wages flexibility helps in automatic regulation of demand and price forces. The goods reach the area having more demand and the equitable distribution is automatically achieved. The European countries, because of this fact, does more trade with the member countries as compared with rest of the world. Then there is shock absorber. Mundell in his second theory explained that if the loss is due to harvest failure or strikes or war, that country suffers the loss of the real income. But with the use of the common currency, it allows the country to draw the resources of the other country until the cost of adjustment has been efficiently spread over the future. Historical experience of the Indian exchange rate system. India, being an original member of the IMF, has to go by the obligation laid by IMF, where it was required to adopt the Bretton Woods system of exchange rate. The Bretton Woods system of exchange rate is nothing but the par value system of controlled rate system, where each member country requires to determine the value of its currency in relation to the gold or US dollar. This system was followed by India from 1944 till 1971. But in 1977, this system collapsed during this time. Indian rupee then was controlled in relation to the pound sterling for 4 years. The value was linked to basket of 14 currencies and thereafter it was reduced to basket of 5 currencies of countries which were having trade with India. The system was continued for a length where a room was given for the fluctuation in order to maintain the competitiveness. Thus, the rupee was allowed to depreciate modestly with minor adjustments till 1980s. But the need to regulate the exchange rate was felt in the year 1991 when the country faced external payment crisis. In the scenario of the economic crisis, the rupee was devalued in 2 stages in relation to US dollar. This system continued for a while, then liberalized exchange rate management system was followed in 1992, which was replaced in 1993 using unified exchange rate system. The system of exchange rate now became where determination was done by the market. The freely flowing exchange rate system was followed along with the exchange control. The RBI had a room of 5% to regulate the exchange rate in case of devaluation of rupee or high volatility. Reserve Bank of India had full convertibility on current account from 1994. Then in 1997, the RBI liberalized various regulations in relation to various services, which are also known as Article 8th status by IMF. This increased the confidence of foreign investors, helping to attract more foreign capital to India. RBI had many controls on current account and it had a control on foreign exchange rate through direct purchase and sale of foreign exchange in the market. This system was continued till more than 15 years and now India follows the de facto pegged exchange rate system. In the scattered courts of Rangarajan and Prasad, with an open economy and large capital inflows, management of the exchange rate becomes an independent concern. Managed exchange rate system offers an attractive middle way between the polar choices of fixed and free floating exchange rates. The element of fixity helps avoid the volatility that might otherwise arise from cyclical and other reversible fluctuations in the current account position. Thus, instead of arguing for the exclusive use of any one of the instruments, there must be a judicious mix of all of the three instruments, hereby thus suggesting that India has to find the position between two corner position, that is either pure floating or hard pegs.
So, in this module, we have learned about the IMF institution and its funding facilities, World Bank and its basic features, the constituents of the World Bank, difference between IMF and World Bank, the concept of optimum currency area and its applicability, the historical experience of Indian exchange rate system.